What if we try a so-called 100% win rate strategy together with the RSI indicator? That's what we're going to explore today. So make sure to read the following disclaimer, and let's give this strategy a shot. Hi traders. Well, do you believe in a trading strategy that works all the time? I don't, but according to basic probability rules, that's possible. But how? Let me give you an example. Let's say you decide to play a game with your friend using a coin. There are two rules for this game. You'll flip the coin, and if it's tails, your friend will give you $1. Otherwise, you need to give $1 to your friend. So you are risking $1 in every single round. That's the first rule, but what about the second one? Well, you can play as long as you want to, but if you lose, the risk goes up to $2. If you lose again, the amount goes to $4, then 8, 16, 32, etc. Whenever you lose a round, the following one will have 2 times the previous risk. This is the Martingale system. Let's suppose that you have $10,000 that you can afford to risk in this game. If we do some basic calculations, we can realize that the only way to lose the entire $10,000 is if we lose 14 times in a row. But imagine if we change the game a bit and begin with 1 cent risk instead of $1. Well, the profit we'll make will decrease for sure, but we'll have more chances to make a profit and recover our loss. The only way to go bankrupt in this scenario is if we lose 20 rounds in a row. For a game where we have a 50-50 chance to win, we need to be extremely unlucky to go bankrupt. To sum up, the concept of Martingale is pretty simple. You increase your bet after every loss. So when you eventually win, you get your lost money back and start betting with the initial amount again. It seems quite logical, and it's fairly easy to understand and implement. No need to be a math wizard or strategic mastermind to use this system. Does that remind you of anything? Well, let's say Forex trading, for example. There are only 2 possibilities regarding the price movement. It could go up or go down. We can either buy or sell. The same thing applies when we think of the coin flipping experience. So what happens if we use the Martingale concept to trade Forex and use an RSI trading strategy to boost up the chances of being on the right side of the market? So we go in when the RSI indicator gives us a buy or sell signal, and we'll double our bet or trade size every time we have a loser. As we continue losing, we continue doubling the trade sizes until we exit the trades with profit. For example, we go short with 1 standard lot. If the price goes against us, we immediately place a sell trade with a volume of 2 standard lots. If the trend continues moving against us, we go short again with 4 standard lots. Eventually, that would probably take some time, but if we continually double our bet or trade sizes, all we'll need is 1 winner to get back to profits. This will require a lot of automation, which is why we'll use an expert advisor built according to this strategy. Before we begin backtesting, let's review the setup again. So we will use the RSI indicator to enter the market. I'm sure some of you have watched the video where we backtested the RSI trading strategy 100 times. I'll leave a link to that video at the end of this one. But to sum up, the RSI indicator has 3 signal levels: 30, 50, and 70. The area above 70 is called the overbought area, which is where we should sell. On the other hand, the area below 30 is the oversold zone, where we should buy. That will increase the quality of our entries. This is our expert advisor. I'll set it to 5 minutes to get as many trades as possible. The most important element here is the initial balance. We'll run this strategy with a $10,000 balance and place both buy and sell entries. No worries, we'll do the same thing with $1,000 and $100, as some subscribers want us to backtest strategies using smaller accounts. Let's look at the other settings. To remain longer in the market, I'll use a volume size of 1 microlot and opt for 70 pips as a fixed take profit. Regarding the RSI indicator settings, I'll stick to the 14 periods and go short when the price goes above 70 and buy when the price crosses below level 30. One more thing before we hit on start. I'll select a 1-year time interval. That's pretty much it. Let's hit on start. While waiting for the results, Don't forget to give this video a thumbs up and subscribe to the channel if this is your first time here. Many subscribers want to learn how they can build an expert advisor to backtest their trading strategy. I'll leave you a link to a great Udemy course that teaches you how to build an expert advisor from A to Z. Well, we have just completed the backtesting process. The equity has tremendously increased, but only by looking at this, I can imagine how high the drawdown would be. So basically, the price has made a sharp move against us in these three instances, and we needed to place many trades to recover our loss. And yes, we had a 72.02% drawdown, which is extremely high. The strategy has a success rate of 82.72%, which seems great, doesn't it? We ended up with a profit that exceeds $30,000. That's a massive return. So imagine beginning the year with a $10,000 account and end up with $30,000. That's probably better than any high-yield savings accounts. Do I recommend this expert advisor or strategy? Well, before I give you my opinion, let me run the same test with $1,000 this time. Simply return to the expert advisor settings and change the balance from $10,000 to $1,000. Let's keep the other settings as they are and hit on Start to begin the backtesting process. We're done now. We can see that the balance has gradually increased, but the equity dropped at the end of the process. And yeah, you might have guessed it right, the drawdown is extremely high, 98.2%, which means that trading this strategy with $1,000 is extremely dangerous, and you could lose your entire balance if the market goes against you with an upward or downward spike. If we check the trades, we'll notice that we remained in the market for only 24 days, which was enough to wipe out our account. Imagine if we do the same experience with only $100. We can remain in the market for how many days? I'll let you guess. I would say 5 to 10 days maximum. Let me run the test again with a $100 balance before I share with you my thoughts about this strategy. As expected, we've lost our balance at the end of the day, despite the profit recorded at the beginning of the experience. The drawdown is 97.35%. I was wrong. We remained in the market for 24 days. Now I would like to know what happened on the 23rd and 24th of September 2020 as we wipe out our accounts on these two particular days. Well, if we check the Forex event calendar, we can see how spicy the 2 days were. Our balance wasn't enough to sustain our positions during this period. It's important to monitor the event calendar to avoid any negative impulses. This strategy is not profitable the way it is now, as it doesn't take into consideration the fundamental events and the times when the market is in high volatility for other reasons. But I'm wondering, what would happen if we try this strategy during a low volatility market and we avoid all major events? Are we going to be profitable? Let me know in the comments section if you want us to continue working on this series, and feel free to suggest any idea you have in mind to optimize or challenge this strategy. Don't forget to check out the other videos on this channel and subscribe so you won't miss any updates in the future. Happy trading!